Today, we're diving into a powerful strategy for building wealth, taking asymmetrical risks. Think of it as a cheat code to getting rich. We'll explain the concept, provide plenty of examples, and give you strategies for discovering these opportunities. Plus, we'll cover the pitfalls of asymmetrical loss. Let's get started. This is Wealthlocity. Here you create, protect, and grow your wealth fast. Asymmetrical risk is a concept where the potential rewards significantly outweigh the potential losses. It's about making calculated bets where the upside is huge and the downside is limited. This approach can be a game changer in your journey to wealth. Think of it this way. A symmetrical risk is like a coin toss where you bet $1 to win $1. The odds are 50-50, and the potential reward is equal to the risk. Asymmetrical risk, on the other hand, is like betting $1 with the chance to win $10, $100, or even more, with odds that are still in your favor. To truly grasp asymmetrical risk, it's important to understand both sides of the equation, the risk and the reward. The goal is to identify investments or opportunities where the potential for gain vastly exceeds the potential for loss. These opportunities often arise in areas where there is a lot of uncertainty, or where traditional investors might be hesitant to venture. The key is to assess the probability of various outcomes and choose those with a high reward-to-risk ratio. One of the most common examples of asymmetrical risk is investing in startups. While the majority of startups fail, those that succeed can provide returns of 10 times, 100 times, or even more on your initial investment. Venture capitalists thrive on this model. They invest in numerous startups knowing that a few successful ones will more than make up for the losses from the ones that fail. Early investors in Google made over 2,000 times their money when the company went public. A $10,000 investment turned into more than $20 million. Investing in Uber's seed round would have given you shares worth hundreds of millions when the company went public, despite many other startups failing along the way. Real estate development is another area where asymmetrical risk can pay off. By investing in undervalued properties or developing land, the potential returns can be substantial compared to the initial investment. Developers often take risks on properties in emerging neighborhoods, betting that these areas will grow in value over time. The risk is mitigated by thorough research and due diligence. A developer who purchased property in Brooklyn before its revitalization saw property values increase by over 500%, turning a $100,000 investment into over $600,000. Investing in vacation rental properties in up-and-coming tourist destinations can yield high returns as the area's popularity grows. Cryptocurrencies are a modern example of asymmetrical risk. While highly volatile and speculative, early investors in major cryptocurrencies like Bitcoin and Ethereum have seen exponential returns. The key is to invest only what you can afford to lose, as the potential upside can be enormous, but the downside risk is limited to your initial investment. Investing $100 in Bitcoin in 2010 would have turned into over $50 million by 2021. Early adopters of Ethereum saw their investments increase by thousands of percent within just a few years. Options trading allows investors to leverage small amounts of capital for potentially large returns. Buying call options, for instance, can yield significant gains if the underlying stock moves in the right direction. Options are inherently risky, but when used strategically, they can offer asymmetrical rewards. It's crucial to understand the mechanics and risks involved before diving in. Buying call options on Tesla before a major earnings report could turn a $1,000 investment into $10,000 or more if the stock price surges. Using options to hedge investments can also protect against downside risk while maintaining potential for upside gains. Angel investing involves providing capital to early-stage companies in exchange for equity. Like venture capital, the goal is to identify startups with high growth potential. Angel investors often benefit from being early supporters of successful companies, receiving substantial equity stakes for relatively small initial investments. An angel investor who funded WhatsApp early on saw returns of over 5,000% when Facebook acquired the company. Early investment in Airbnb by angel investors resulted in significant returns when the company went public. Investing in intellectual property, such as patents, music royalties, or trademarks, can also offer asymmetrical returns. Successful IP can generate ongoing revenue streams far exceeding the initial investment. IP investments are less talked about, but can be highly lucrative if you identify undervalued assets or emerging trends. Buying music royalties from an emerging artist can pay off handsomely if their career takes off, providing steady income from streaming and sales. Investing in patents for emerging technologies, like renewable energy innovations, can yield substantial returns as the technology becomes widely adopted. While not a classical investment, the lottery is one of the most basic examples of asymmetrical risk. The potential reward is enormous, while the risk is limited to the cost of a ticket. For a few dollars, you buy a chance to drastically alter your financial future. The odds are slim, but the potential payoff is life-changing. A $2 lottery ticket can win you millions, as seen in numerous jackpot winners who turned a small purchase into a fortune. Group lottery pools increase your chances of winning without significantly increasing your investment. So, how do you find these asymmetrical opportunities? It requires a combination of research, networking, and staying ahead of trends. Here are some strategies to help you discover these high-reward opportunities. First, research emerging trends. Keep an eye on new technologies, market shifts, and emerging industries. Early adopters often reap the biggest rewards. For example, investing in renewable energy companies before they became mainstream provided significant returns for early investors. Second, network with industry insiders. Build relationships with people in the know. They can provide insights into upcoming opportunities that aren't widely known. For instance, networking with venture capitalists and startup founders can give you access to early-stage investment opportunities. Third, leverage data and analytics. Use data to identify undervalued assets or trends that others might overlook. An example would be analyzing real estate market data to find undervalued properties in up-and-coming neighborhoods. And lastly, stay informed. Read industry reports, attend conferences, and follow thought leaders to stay ahead of the curve. For example, subscribing to financial newsletters and attending blockchain conferences to stay updated on cryptocurrency trends. To determine if an investment has asymmetrical risk, consider the following criteria. First, low entry cost. The initial investment should be relatively low compared to the potential upside. This limits your downside risk. For example, investing a small amount in a promising startup through a crowdfunding platform. Second, high potential returns. The investment should have the potential to yield significant returns, often multiples of the initial investment. For instance, investing in a tech startup with innovative solutions that could disrupt the market. And third, manageable risk. The risk should be manageable and well understood. You should be able to absorb the loss without catastrophic impact. For example, investing in real estate properties in emerging neighborhoods after thorough research and due diligence. While asymmetrical risk can lead to significant rewards, it's important to be aware of investments that offer asymmetrical loss. These are high-risk investments where the potential losses far outweigh the potential gains. One common example is short-selling stocks. While the potential gains are limited, the potential losses are theoretically infinite if the stock price rises. Shorting a stock at $100 only to see it rise to $500 can lead to catastrophic losses, far exceeding the initial investment. Leverage trading, such as using high leverage in forex markets, can result in significant losses if the market moves against you, wiping out your investment and more. To avoid asymmetrical losses, it's crucial to conduct thorough research and risk assessment. Understand the risks involved and never invest more than you can afford to lose. Consider diversifying your investments to spread risk and ensure that high-risk investments are balanced with more stable ones. Instead of putting all your money into shorting stocks, diversify with a mix of equities, bonds, and other assets to mitigate risk. Using stop-loss orders can help protect your investments by automatically selling positions that fall below a certain price, limiting potential losses. In conclusion, taking asymmetrical risks can be a powerful strategy for building wealth. By seeking opportunities where the potential rewards far outweigh the potential losses, you can position yourself for significant financial gains. Remember, the key is to conduct thorough research, stay informed, and be strategic in your investments. And always keep in mind, if an opportunity looks too good to be true, it probably is. Stay cautious and make informed decisions. Thank you for watching. If you found this video insightful, please like, comment, and subscribe for more wealth building strategies. See you next time with more money in your pocket.